Hi, very good evening, everyone. Welcome to this another round of exclusive webinar session conducted by Bajaj Finance Limited for our esteemed viewers. As you know that yes, today's markets are going extremely up and it is touching almost all-time high in terms of Sensex and Nifty 50. We thought we need to have some kind of expert from our mutual fund industry who can share his valuable thoughts with us that how the future and how the outlook is for equity, what the investors should do in such kind of scenarios, whether it's the time to book the profit or whether to increase your portfolio or review your portfolio. I think there are so many questions in our mind. So we just thought to introduce one of our esteemed speaker, Mr. Trideep Bhattacharya from Edelweiss Mutual Fund. Mr. Trideep comes with over 2 decades of experience in equity investing across Indian and global markets. Prior to joining Edelweiss AMC, he was instrumental in building a market-leading PMS business at Axis Mutual Fund as Axis Asset Management Company as Senior Portfolio Manager, Alternate Equities. He has also spent a significant amount of time as Portfolio Manager at State Street Global Advisors and UBS Global Asset Management, London, UK. When not occupied with work, Tridip loves playing tennis, bridge, and his hands on few instrumental musical instruments. So I believe with such kind of diversified um, uh, work experience as well as personal interest, I would invite, without taking much time, Sudeep, to share your valuable thoughts to the investors, how the equity market look likes, what the investor should keep in mind right now while making any kind of decision or portfolio, and what is the right way to invest in such kind of market scenarios. Over to you, Mr. Sudeep. Thank you so much.
Thank you very much. Thanks for the current introduction. Good evening, everyone. And thanks for giving me an opportunity to present my thoughts on equity markets to all your viewers. And I know Bajaj Finance is as successful a franchise that India has ever produced. Let me start by saying, having been an investor in Bajaj Finance for a good while, I'm glad that I'm on your platform, speaking to your investors, talking about equity markets. And what an opportune time to for you to call me. The market just hit all-time high, and I was on CNBC yesterday talking about all-time highs and whatnot. I said, look, I mean, one of the ways is it's all-time high. The other way to look at it is that if you look at 1 year back, from 1 year back, we are just about up by a bit, which means that for 1 year, markets haven't gone anywhere. So you could look at it glass half full, glass half empty. It's a good circumstance to sort of ruminate, think about equity markets and a way forward. So with that background, as I'm speaking to you for the first time, I would first put in a bit of a context as to where the thinking is coming from. Talk to you about the view over the next 12 to 18 months, and then a slightly longer term, which is 3 to 4 years, and then leave it open for questions. Overall, I'm thinking to present for roughly about 30 odd minutes, which means I will not keep you for long on a holiday. But hopefully, after that, from the questions, we can have an interactive session. Yeah. So with that, I think the stage I would set is something like this: that every year end, I put my thinking cap together and write a piece with regards to what I expect the next year to look like. And when I did the same end of 2022, early 2023, I came with a catchphrase for 2023 as recession before rebound. And in essence, what I was looking to say at that time is that the first 6 to 9 months, the macro conditions are likely to be tough for companies, for equity markets, and stuff like that. The earnings estimates would have to sort of go through a headwinded environment from a macro standpoint. And as we get towards the year-end, macro conditions would probably kind of, a little ease it to a certain extent. And I think, at the time when I wrote, the resident view at that time was that inflation has peaked, interest rates have peaked, and now kind of, we will march forward. But standing towards the middle of the year, if I were to do a bit of a dipstick kind of an approach and figure out where are we since the beginning of this year, I clearly note that the interest rates globally have gone up anywhere between 75 to 100 basis points. Even in India, where inflation issue is not that prominent, here the interest rates have gone up by about 25 odd basis points. And in other words, the macro conditions have actually tightened. We've seen a couple of bankruptcies with global financial global banks, like we saw HSBC or Credit Suisse. And we've been quite accident prone, quite volatile. The first 3 months have been kind of, particularly on the way down. And the last 3 months, you've seen a bit of a rally. Net, we are there where we were. So this is exactly what I thought about when I wrote Recession Before Rebound, and the macro conditions are likely to be tough in the first 6 to 9 months of this year. And standing today where we stand, overall in end of June, early July, I would say that, we are gradually coming to a stage where we are reaching the top of interest rate cycle along with the inflation cycle for this cycle overall. In other words, with interest rates peaking out, inflation peaking out from here on, the back half of the year is somewhere where you would see macro conditions, which have been quite tough since the beginning of this year, ease a little bit. I'm not making a strong case for macro interest rate cuts or inflation cuts as we go along, but certainly the headwinds caused by rising interest rates would actually stall from here. So slightly easing macro. But the slightly easing macro will actually come with a headwinds with regards to earnings estimate. This will also be the time when growth rates in United States, Europe, particularly global markets, which actually start to slow down. And this is an impact of basically over the last almost 12 months of tightening that we have seen so far. And the tightening has been quite huge. I mean, if you look at it overall in the last 12 months, we have seen in globally almost 500 basis point increase in interest rates, which is the fastest in the last 50 years. And when I studied the history of equity markets over the last 100 years, there are only 2 times this happened. The last time was in like 70s or 80s. And from a growth point of view, we saw material amount of weakness in growth as the rise in interest rate took its toll on growth rate. I think globally, you would see something like this play out towards the back half of this year. But the good news is that with macro conditions easing, somewhere towards the end of this year or early next year, the rebound part of the hypothesis will start kicking in. That's one. And secondly, even though you would see contracting growth rates globally, like in the United States, Europe, and Asia, and China, and whatnot, India relatively will see a bit of slowdown, but with regards to growth rates, you will not see probably recessionary conditions like we would see in the rest of the globe. So in other words, as we get towards the back half of this year, brace up for a bit of volatility, brace up for the fact that the macro conditions, which have been tough, would actually ease to a certain extent, but the growth rates that you will see coming out of United States or Europe or Asia will actually soften before they start rebounding. So that's the near-term outlook in front of you, how I would see the back half of this year. Basically, better part of this year would be the recessionary conditions. Earlier, it was from macro conditions. The second half of this year would be from micro, bottom-up standpoint. But as we get towards the back half of this year, we would probably get to a situation where economies globally as well as in India would start gradually preparing for a rebound. And that, ladies and gentlemen, is what hopefully kind of, keeps you interested in equity. That's exactly the holy grail why we should be kind of, waiting for that time to come through, because that's when the times when equity markets do well are usually the times when rates have peaked or rates start coming down, inflation's coming down, and growth rates gradually starts to look up. That's a very good combination from an equity market standpoint. That combination, in my opinion, will most likely come through sometime in the first half of 24. Macro can always change a little bit here and there, but broadly speaking, that's how I see the near term play out over the next 6-9 odd months. Now, the reason why you all as investors should be interested in equities is because, in my opinion, once the rebound starts, the characteristics of the rebound makes me particularly enthused about equities and particularly enthused about Indian equities. And that is where I think we have a strong story to say. The majority of the crux of today's presentation is what I'm going to say now. So please focus on that. So in a nutshell, so far I have covered that we have been broadly dealing with flattish or a time correction in equities so far. And we will probably see that happen as we head towards the year end as well. But the Amrit Kal of equities, really, if you were to call it that way, would start as the rebound starts. And as the rebound starts, in my opinion, there are 5 themes, bottom up, that they are for India that are multi-decadal themes, in the sense that for the first time in a decade, it is happening in India, and which makes me feel that the bull market that you will see subsequently would be fairly robust and would actually benefit investors in a major way. So what are those 5 themes? The first theme that I would talk about, which will characterize the rebound in economy, in Indian economy and equities, is basically the private sector capex theme. Now, in my opinion, the Indian private sector has gone through a meaningful amount of deleveraging over the last 3-4 years. Finally, from a growth in capacity standpoint, we have reached a capacity utilization of 74-75%. And because of this deleveraging, they have a bit of cash on their hands. What that means is, for the first time, the private corporate sector is looking to invest in terms of putting factories in place, this, that, that. Now, this, in my opinion, is a 5-year theme, and this is happening for the first time since 2002 to 2007. I mean, subsequently, we haven't seen any private sector capex come through. Capex has been mostly led by public sector. But the incipient signs of capex coming through are very much there or thereabouts. So, in my opinion, this trend will actually accelerate once, mind I say, if we see macro stability post 2024 election, we will see this trend further accelerate. So it's a fairly long-dated theme, in my opinion, where for the first time in the last 10 years, private sector is looking to do capex. At the moment, we are mostly seeing demand in working capital and brownfield capex. But overall, over the next 3-5 years, you will see greenfield capex also come through, which is what I remain optimistic about. If you are looking for data points, already
there is some network issue at your end, I believe.
Okay.
I can see some lag in your voice. If there's some network issue, you can do one thing. You can switch off the video and continue with the same. Maybe it will be better.
Is this better? Can you hear me? Is this better?
Yeah, Tridip, it is completely fine. Please go ahead.
Okay. So I was saying that overall, the first theme that we were talking about was the private sector capex theme, and I was talking that overall, if you were to look at the project announcements that have come about so far, this have already crossed decadal high, and project announcements are something which obviously is the intention to put on the plant on the ground. It has not yet happened, so it will most likely happen. But over the next 3 to 5 years, you would see this trend further intensify as we go by. So that's the first theme, which is basically private sector capex. Beneficiaries of these would be clearly infrastructure, capital goods, and the likes. And we think that's a very fruitful theme from a 5-year perspective. The second theme that I would like to talk about is basically, again, for the first time in the last 5-7 years, lending financials seem to be in finding their spot in the sun. What do I mean by that? Now, Bajaj Finance, yourself are a lending financial, so you would know that over the last 3-5 years, the lending financials, whether it's a bank or an NBFC, has gone through a meaningful NPA cycle. And with the corporates having delevered, their balance sheets are absolutely clean from an asset quality standpoint. And with credit growth picking up in the economy, as we talked about CapEx theme, we think that from a next 2-year perspective, lending financials are in a sweet spot. They certainly kind of, overall have valuations in their favor. Fundamentals are bottoming out, and that's the sweet spot from an investor standpoint. So the second big theme, which in my opinion will play out for India Inc., would be basically lending financials. Okay. The third area that I wanted to talk about is, again, first time over the last 15 years, a trend which is happening, and I would say it's still in its early stages. We are probably in the first 2 to 3 years of a 5 to 7 year upcycle, is basically the sector what we call as real estate or household capitals. One of the data points that I saw about 6-9 months ago was that across India, the unsold inventory, which means the builder has already built the flat, builder ne flat bana diya hai, but the flat has not been sold. The unsold inventory is basically at a 10-year low. And when I observed that data point and went behind it, what I noticed is that whether it was DMON, whether it was RERA, or for that matter GST, a lot of bad blood has flown through the real estate sector over the last 4 or 5 years, and finally kind of COVID. Coming out of it, we now have a sector wherein inventories in the traditional sense are at rock bottom. Prices are gradually starting to look up, and overall builders don't have any or have consolidated, and the bigger builders are now financially in a far more cleaner state. That makes me feel that real estate would have an upcycle over the next 5 to 7 years, where we are somewhere in the first 2 to 3 years, where inventory is just about bottoming out. Now, this is a particularly important theme. The reason I say so is this is unique to India in many ways. Now, I'm sure your viewers would have noticed that China real estate is in a bit of a tough spot since Evergrande.
Yeah.
US new home sales have been seeing good amount of weakness.
Yeah.
And in that context, India real estate looking up adds a lot of bottom-up strength to the Indian economy, which is why even on the face of global weakness, you have seen Indian growth rates still or Indian earnings still resilient. That's one. The second part of why real estate becomes important is because so far, really, we have seen a K-shaped recovery. And if real estate picks up, the employment and the ancillary sectors that benefit from the same has the potential to make the recovery a lot more broad-based than what we have seen so far. So it has multiple significant correlations before, not just from an equity market standpoint. It has fairly significant connotations from the economic standpoint as well. So net, real estate is bottoming out, is in part of an upcycle from a 5 to 7 year perspective. And we think that there are two ways to play the real estate. One is the direct way, which is the builders. The second is basically the indirect way, the building materials, the kind of ancillary sectors which play into real estate. So we think that building materials or the ancillary plays to real estate are even better way to sort of play this upcycle over the next, I would say, 5 to 7 years. Again, another trend which is happening first time in the last 10 years. The fourth area that I would present in front of your viewers is basically an opportunity where we have the size of opportunity significantly larger and we don't have supply enough to take care of. Now, usually in India, we are faced with a situation where, you know, before the opportunity comes up, supply comes about. And that means margin pressure and a whole lot of trouble for manufacturing. But this is one area where the opportunity is 10 times that of supply. And hence, in my opinion, this is a 10 to 15-year trend which is just about starting. Ladies and gentlemen, I am talking about indigenization of defense as a theme for India Inc. Now, with such a long-dated theme, there would be spurts and there would be kind of, tough times. All of these would be there. There would be cyclical ups and cyclical downs. But structurally, we are headed meaningfully north from indigenization of defense standpoint. We are very in the early stages where the listed companies are only the public sector. The private sector ones are just about getting listed. But if you hold on to your horses over the next 5-7 years, see a plethora of listings in this area, and you will also see a whole bunch of new companies coming onto equity market, making this team even stronger. So the fourth theme is basically indigenization of defense, where we think again in part of manufacturing sector, but would do materially well over the next 4 to 5 years. The final area that I would talk about is, I think, it's a bit not block-led, a bit government-led. So I would put it as beneficiaries of growth scheme. But in this, I include China Plus One, I include beneficiaries from the PLI schemes, and all of these put together. And I think the way I would say this is, I think finally the government of India and the North Block has understood that if we have to stand anywhere in the manufacturing side, we have to build scale. We can't have inverted duty structures and make make hay by giving subsidy. And I think that is a great step forward, which they did about 3 or 4 years ago when they rationalized the tax structure, made it more level playing field between India and other competing countries as attraction to global companies doing their manufacturing work in India. And what happened by a bit of luck as well, that the China relationship with the United States were strained and global geopolitics were a little tougher, made a lot of global manufacturing companies look at India as kind of, as alternative source of sourcing, not just from China. And that kind of, that was a bit of a few things coming in our way, but we also took the right step. So we would see basically a good, trend coming about. So net, if you notice in the last 15 minutes or so, as we talked about the next 2 to 3 year, or maybe 3 to 5 year, or even longer situation in India, we talked about 5 multi-decadal themes, which are happening for the first time in the last decade or so, and have really long-dated legs. So that on the back of these 5 themes, my sense, and I would probably say with some degree of confidence, that the golden years of Indian equities lie in front of us, and particularly in the next 5 years or so. But before we get to that, before we take to the golden period or the Amrit Kal, whichever way you want to put it, we have to survive through the volatility, which is driven by rising interest rates, increasing inflation. Majority of it is behind us, but maybe 3 to 6 months more of the same. So I think the message to investors, the call to action is use this time for, which has been by and large kind of, in a time correction mode, the markets over the last 12 to 18 months, to gradually increase their exposure to Indian equities, and be ready once the economy takes off, with some of the macro headwinds years away, and earnings estimates start to show their true colors. So that's how I would sort of paint in front of you the equity market outlook, which is the near term, the medium term, and a few bits on how to go about investing in such markets. That's where I would stop, and happy to take any questions.
Great. Thank you so much, Trideep. Thank you for giving a complete macro and micro level view to our viewers. And interestingly, you have completely mentioned that yes, since inflation is going all time high, and since the lower interest rate scenario is about to come maybe in 6 months' time, there will be again opportunity for equity investors to put. But yes, considering the volatility, what do you suggest the investor should do? So should
So,
he
in
enter
my
into market at this levels, or should he use the STP format to put some of the lump sum money into it? So if you can just throw some light on that kind of strategy.
great question, Mohit, and with my visuals on, can you hear me clearly? All right, this time.
Yes, absolutely.
Okay, good. So, I would say that I would avoid lump sum at this moment.
Okay.
I would basically from here to the year end use an STP mode to enter into the markets.
Okay.
And basically, what that would do is even out the volatility.
Hmm.
I mean, trust me, we have seen good amount of volatility. If you look at from Jan to March and March to June, we have seen market movements of 10%. So we
Yeah.
could see meaningful amount of volatility in front of us as well. So I would
Hmm.
encourage investors to go in the STP mode from here till the year end, and then what that will do is, on one hand, even out the volatility. On the second hand, they
Hmm.
are well prepared to enter into the markets
Yeah.
when we have the kind of the rebound part of the hypothesis in recession before rebound and it
Mhm.
starts to kick in.
Okay. Unlike, in fact, I was speaking to a couple of people who were saying that yes, now since the interest rate will start going down, it's the time to invest in debt. But do you think with the taxation benefit is no more an attraction for the debt mutual funds, will equity will still gain the attraction in that scenario?
So again, good question, Moy. I would say that look, I mean, you would as interest rates go down, you would get a bit of fillip with regards to debt. All those short-term movements would
Yeah,
be there. But
yeah,
before you get too much swayed into the short-term moves, you have a couple of things in mind. In my
hmm,
opinion, we are moving into a situation where inflation is likely to be sticky.
yes,
And in times when inflation is sticky, there are two asset classes which do really well.
hmm,
One is equities, because
yeah,
equities are the best inflation hedge that you can think about over the long term, over the medium term.
yeah, yeah,
And the second is gold. In times when equities don't do well, there is stagflationary environment or recessionary environment, gold protects the downside. So
uh,
those near term ups and downs, I wouldn't go into too much. But from a medium term standpoint, these two asset classes, which is equities and gold, certainly investors should kind of pay attention to, and have good amount of allocation.
And in fact, I was reading somewhere regarding the gold itself that there's a dip in imports of the gold by 40%, which shows that yes, people are now having interest in digital gold, right?
Correct.
So for our viewers, what do you suggest, gold ETF or gold mutual funds?
Look, I am not an expert on gold. It
Okay.
took me 25 years to build expertise in equities. I would stick to that. But I would say, from a very top down perspective, and you are probably better equipped to advise on which form of gold exposure. But I would probably say that whichever way you do, once you speak to your advisor and get the right
Yeah,
form of exposure, these two asset classes one should certainly have good amount of exposure to.
certainly,
The third
certainly.
area that I would suggest, even though you sort of not asked that question, is even within equities,
Hmm.
while it pays to be risk averse, it pays to be kind of in flexi cap or kind of large cap oriented environment. As the investor gets more confident of the rebound and I have to play the rebound over the medium to long term, I think some of the mid cap, lower down the market cap chain, is something which we should consider.
Okay.
Again, in tranches with a view of 5 to 10 years, not shorter. But given what we are experiencing in India as a phenomenon, I think it will be imprudent not to take any exposure to that. How you go about it, what portion of your asset allocation it should be, that I
Yeah,
leave it to yourself and your advisor. But
yeah.
certainly, exposure should be there. Would be the third advice that I would give in the way of going about this.
Certainly, certainly. And in fact, I always tell people that yes, whenever you are having a hunger you can never depend on a single meal all the time. You cannot be on rice all the time. You cannot be on salads all the time. You need to have a buffet with you, or you have options so that you can keep on changing. So no single asset class you can be dependent on your portfolio. You have to have a right mix of various asset classes within the portfolio, so that it should work as a hedging tool as well. As far as markets are concerned, no asset class performs well in a single year. Of course, there is always a flavor of the year. So there should be a right balance approach. And in fact,
Absolutely.
as you rightly said, so as to minimize volatility, it's not the right time for putting lump sum and starting doing investments through STP. SIP is something I believe there is no right time to invest in SIP, and everyone should definitely start and keep putting the SIPs for yourself. That is a right way of disciplined investment, I would say, without considering whether the markets are all-time high or all-time low. Okay. There's a question from Mr. Pradeep from Delhi that whatever 5 points you have mentioned, 5 sectors or themes to focus on, what is the right way to invest in these themes? Is there any particular sectoral fund one should consider, or maybe a flexi cap or multi cap fund? So, what is the right way to invest?
Uh, I mean, I make it a point of not just marketing my funds, but
Yeah.
I certainly have to say that the 5 themes that we talked about are very nicely populated across all the strategies that we at Edelweiss run.
Yeah.
I would probably kind of, put forward the flexi cap fund, or the mid cap fund, or the focus fund, whichever the appetite of the investors is. I'm deliberately giving a bouquet so that people can choose from whatever they look at, rather than kind of getting hold on to one.
Yeah.
But those would be the three funds that I would kind of, point you to. But I would probably also say to maybe shy away from pure sectoral funds. And the reason why I am saying so is, or the right way to put it, that if you invest in sectoral funds, you will have to decide when to go in and when to go out, and that timing can be
Mhm.
very difficult occasionally for investor who is kind of focused on his day job and can't really time that. So it's best to kind of own a diversified fund wherein these schemes are dominant, and the fund manager has a bit of a leeway to sort of toggle between the themes based on the near-term valuations that they offer, and the attractiveness that they present at that point in time. So, for example, if there are 5 themes, I have sufficient amount of choice which I can exercise across all of these 5 3 themes in terms of
Yeah.
allocation. But if you are investing in just one sectoral theme, for some reason, if it gets a setback, then you will have to switch out or do something about it. So that's why
Right.
a diversified fund is always better. And the funds that I talked about, whether it's flexi cap or mid cap or focus fund of the device, are amply populated with the same.
And in fact, in most of our such kind of webinars, we always tell the customers it is always better not to go to a chemist but to a doctor when your health is concerned. And similarly, while investing in equity, until unless you yourself are so robust to understand the stocks, always prefer mutual funds, which is managed by the experts, and they do have eye over the funds and the performance and the stocks and the performance day in and out, and to take care of the investments of the uh, customers. So
Very
that
well
is
said,
good.
Mohit. I'm going to borrow that phrase from you and use it subsequently.
So Miss Promila from Calcutta is asking, what about the auto industry view? Since we are seeing now focus on EV vehicles, right? In the next couple of years, every auto industry is expecting some kind of, I would say, target setting that yes, minimum this much of percentage they will have EV. So, what is your view on the same on the auto sector point of view? Any recommendations?
I would start by saying that we live in an age of disruption.
Yeah.
And even an industry like autos, which is 100-year-old, is going through meaningful amount of disruption. And the disruption is basically EV. Now, to kind of make you appreciate what I'm talking about, if you are an incumbent with regards to an ICE engine. That EV could be an incremental addition to your revenues, but could cannibalize your existing revenue. So once you appreciate this, you will realize the problem that the auto manufacturers are going through at the moment. So the view on auto sector is selective. We are particularly careful while choosing the OEMs to choose those ones which actually are net beneficiaries from EVs and don't face too much of headwinds when it comes to replacement of their existing stock. However, auto ancillaries are, in my opinion, in many ways, a structurally better position to handle this disruption because they are not hooked on to one particular OEM to succeed. They service multiple OEMs and not just in India, abroad as well. So, from a structural standpoint, within the auto sector, I would point more towards auto ancillary rather than autos. But even within autos, there are multiple things to play. One of the areas that we are positive for is the two-wheeler recovery, and accompanied by a bit of recovery in rural. And what we are seeing overall, we think that that could be a kind of good way to play this. So, in a nutshell, what I'm saying is autos, we are selective. Within the sector, we are playing either two-wheelers or auto ancillaries or wherever we think bottom up. That segment is seeing a good amount of positivity. That's what we are going for, rather than kind of just thinking of them as an interest rate sensitive and being overweight in the same. So it's a bit more complex than a simplistic sectoral view, but hopefully I'm able to get the points across.
I believe that's the reason why we call experts from the industry who don't want to just give a macro view, but the micro view also, that there are smarter ways to invest in a sector instead of going straight to auto. Great, great. There's a question from Mr. Ashok from Raipur, who is asking that yes, what if, how is the right way of investment in this particular scenario for the global equity point of view? So, any view on the same?
Global equities, in my opinion, is a very complex phenomenon today as opposed to a year back. Let me elaborate what I mean. So earlier, about a year or so ago, a global investment would be US, Europe, emerging markets. Everybody was bunched into one bunch. But if you look at over the last year or so, the growth trajectory of India and China has been materially different. The growth trajectory of Taiwan, South Korea, and that of India has been materially different. In many ways, the world is actually, from a structural point of view, getting a little more multipolar than what we have been used to over the last decade or so. Yeah. So in these circumstances, investing in global equity should be done very carefully. It needs to be done with a particular attention to where you are investing. If you're investing in US, then clearly you are investing in a hotbed of innovation. It may go through its volatility, but it will certainly have its day in the sun over time. But the rest of the bunched up investment, which is emerging markets or Europe, those bunched investment one should stay away from and make focused investment with regards to where they are. But having said all of this, in my opinion, global allocation should certainly be there for an investor as part of diversification. Should certainly be part of an asset allocation strategy of an investor. What I am highlighting is you should get in touch with your advisor before making a global allocation and be mindful of the countries that you are betting on. As a data point to all your viewers, let me say that I was speaking to FIIs and global investors, and there is suddenly a demand for launching Asia ex-China funds.
Yeah.
That goes on to show that certainly the country dynamics are becoming a lot more important rather than the bunched up, the groups of countries like emerging markets or those kind of connotations. So, certainly it should be part of allocation. Speak to your advisor with regards to how to go about it. I certainly think that of whatever you do, India should be a main part of your portfolio for the next 5 years. Not just because I manage Indian funds, I do manage some global funds also. But just because of the 5 pointers that I talked about, we think that we have a good story going, which is on a bottom-up basis. Investors, at least in India, should not miss out on that. I can understand if a US investor misses out on that. But if we miss our own story, it'll be a big shame to come on your channel and not talk about it, and for them to be seeing, being part of it, but not capturing the same in the portfolios.
In fact, everywhere we are seeing that yes, this decade is India's decade in terms of manufacturing, in terms of technology, and in terms of in-house manufacturing. I would say Atmanirbhar, and budget also recognized Amrit Kal as a period for India for coming decade. I would say so. I believe Indian equity is having a lot of potential in terms of instead of going overexposure in global equity. Diversification is important, but that should be done in a such a manner so that they should not be overloaded or heavy lifting on certain sectors. And that is how our experts through this webinars try to make people understand that how the portfolio should be balanced and what all sectors need to be considered. With this, Sudeep, I don't find any other questions, but I believe that yes, our viewers have got definitely a very good understanding of the equity markets in a near term as well as medium to long term, what approach they should follow, what all factors and what all sectors they should chase and should consider for a part of the portfolio, and what should be the right strategy, STP and SIP, what is the right way to invest. And I would again like to thanks for your valuable inputs, and thanks to all the viewers who have taken out time from their esteemed schedule, especially on this holiday, to attend this webinar. And I hope this solved a lot of doubts inside you that yes, how the markets are moving and what exactly you should do. And thank you once again, Trideep, and thank you, Edelweiss Mutual Fund, for taking out time for our viewers. And we'll definitely be in touch and we'll definitely attend, organize such kind of webinars for our esteemed viewers. Thank you, Trideep. Thank you, Edelweiss team.
Thanks, Mohit. Thanks to all the viewers. Happy investing, and hope to see you soon. Bye bye.
Bye bye. Thank you.